Hello, everybody, and welcome to Intermediate Accounting Earnings Per Share Basic and Fully Diluted. This is my first part in this series, which is a general overview. My disclaimer and copyright notice, the information and opinions in this presentation are those of myself, the author, and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Long Beach City College. I also serve as a director on several different publicly traded companies, and my opinions here are not my opinions as a director. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2021 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. If you would like to distribute this, please contact me first. Right, so if you're free to watch it on YouTube, all you want to do, but if you're going to take it and put it someplace else, contact me. Okay, so here's an overview in terms of why is earnings per share? My English is terrible today. Why is it so important? By the way, huge shout out to Regina, one of my former students. She basically asked for this video. I think she's probably going to regret it, but here we go. So what is our overall, before we get to EPS, what is our overall objective of financial reporting? And one of the things I have my students do in the very first semester of intermediate accounting is I have them memorize the tree, or basically when you're looking at all of the different factors that go into financial reporting. However, the overall pervasive element, and this is by Kiso and Weingart, 17th edition, published by Wiley. The overall objective of financial reporting is to provide information about the reporting entity that is useful to present and potential equity investors, lenders, and other creditors in their capacity as capital providers. Okay, so it's a lot to kind of take in. But again, why are we doing financial reporting? Well, we're not doing it for the company. The company the company's reporting its own numbers, but it's really here is that we're doing it for the investor. Investors are investing in different companies, and so they need information to say, do I want to keep, sell, buy more of my investment? So we're also going to kind of talk today about the price to earnings ratio and why this is really why earnings per share is so important. We're also going to talk a little bit about basic versus fully diluted earnings per share. Also preferred stock for publicly traded companies. We'll see kind of how that works. And then lastly, what investors are really interested in. Okay, and this is kind of a push that I have towards better transparency. Okay, if I look at earnings per share, what this is going to be is net income minus preferred dividends. And I'm going to divide this by the weighted average shares outstanding. Now, most publicly traded companies will not have preferred stock, and it's really, I think it's more like on the regulatory side, or if there are preferred shares, they're not being issued because they're generally all converted before they go public, because there's this kind of like this perception that one public share, like if I'm an investor in one shareholder, that the preferred will have preference over me. So that's generally something that doesn't happen very often. That might not be the correct explanation, but it's part of the reason why most publicly traded companies don't have preferred shares. So it's net income divided by the weighted average shares outstanding, common shares outstanding. This is going to give me earnings per share on a basic level. Okay, so this is basic. Now, what are the things we have to think about? Well, when we look at authorized versus issued versus outstanding is one of the best ones to kind of go through and look at is if I go to the Home Depot, and you've seen me on other videos talk about the Home Depot. But the reason why I always like to talk about the Home Depot is because they're probably the best example of a company where it really is easy to tell about authorized, issued, and outstanding. So when I look at this over here, they have par value 5 cents, a little high. Authorized, right, is 10 billion shares. And issued shares are 1.7 billion as of August 1st. And then outstanding shares is 1,056,000,000 shares at August 1st, 2021. What does issued, authorized, and outstanding, what exactly does that mean? Well, authorized is that when I initially incorporate, what ends up happening is that I have to go through and tell the state that I'm incorporating in how many shares I'm allowed to issue up to. It's not the actual amount I'm releasing, it's just the total amount I can go through and do, or shares that I can issue. So authorized, right? Doesn't mean that anything's been issued, they're just authorized. So when we look at a company like Home Depot, did they start out with 10 billion authorized shares? The answer to that is no. They probably started much smaller than that. However, as a board, as a company grows, is that you can authorize more shares. It's just going to cost you more money if you're in Delaware, which is probably the only state you really want to be in, okay, for corporations. Okay, so it's authorized. Okay, so the other part here is issued, right? This means that these are shares that I've actually issued at one point in time or another to the investing public. So I've issued 1.791 billion shares. However, outstanding is different. Why is it different? It's because this represents roughly 735 million shares that the Home Depot has repurchased. So as you see right over here, 735 million shares. So Home Depot has repurchased 72 billion worth of its own stock. So as you look at this, right? So as we're looking at these numbers right over here, issued is shares that the company went out and sold to investors. Outstanding, though, represents what I sold to investors less any shares that I've gone through and I have repurchased. So, and the reason why I'm kind of spending a little bit of time on this, because when we get into weighted average shares outstanding, when we talk about this in terms of the problems or the questions, this is going to come up. So treasury stock, just remember, it's basically represents those shares that I've bought back from the investing public. It shows up as, this is not a liability, but it's a reduction in our owner's equity. So when we look at earnings per share, I'm looking at the shares that are outstanding. Okay, so I'm not going to be looking at those shares over here that have been issued. I'm looking at the outstanding shares. And if I went and looked at roughly, if I went over here and looked at it, the way they're going through and computing basic earnings per share, and this is just for the 3 months ended, as you can see here, they're going through and they're using that 1,058,000,000 shares outstanding to compute earnings per share on a basic level. So you can kind of see where they're kind of going through and doing that. So that's the basic formula for earnings per share. Now, one of the things I also mentioned too is with regards to the concept of net income minus preferred dividends. I generally have not seen a lot of preferred stock out there. It was common a lot like a while back. However, what's generally happening now with most companies is what they're going to go through and do is, why do you have different classes of stock? It's really about control. And so you'll see some things where like Mark Zuckerberg was trying to do some stuff, but Mark Zuckerberg will never be voted out of Facebook. He can never be voted off the island because he owns a majority basically of the shares that are down here. Right. And I can't remember if it's the class A or class B, but what most companies do today is they'll have two separate classes of stock. So they'll have common stock class A, common stock class B. Okay. And this is really What this is really kind of going through and doing is that these generally will have different voting rights. So instead of using preferred shares, remember preferred shares, you can say, oh, you've got like non-voting preferred, you got voting, they're convertible, they're cumulative, all that other stuff, right? Most companies today, they're just going to use common stock and they're going to create different stock classes because from a securities standpoint, it's a little bit easier to kind of deal with. Going back to my earlier comment, if I look at Snapchat or Snap, Crackle and Pop are very sad because they're not included in this. That's my bad accounting humor for the day. And there's probably going to be more coming where that came from. If I come down over here to the balance sheet of Snap, what you're going to notice is, oh, Class A non-voting stock, Class B voting stock, Class C voting stock. So within a company, you can use different shares. Or different types of stock. So you're really not going to see a lot of in terms of like the preferred dividends. Not going to really see that happen that much, but obviously for the CPA exam, you have to kind of keep that in mind. So, but over here, so again, just kind of keep in the back of your mind that what's authorized, issued versus outstanding. With earnings per share, we're concerned with outstanding shares, meaning those shares that are actually being held not by the company, but by external investors. Also could be a CEO, but again, they've been issued and they're being held by somebody else, not the company. And how owners can give up ownership while maintaining control, Class A, B, and C shares. Okay, so that's really where that part of it is. Okay, now we've computed this price to earnings ratio. Ooh, for two. Oh my God, wow, it's early in the morning. So we've computed this price to earnings ratio. Right? And what exactly is the price to earnings ratio? It is going to be the stock price divided by earnings per share, generally basic. And what this tells us is how many years will it take a company in earnings to earn back its stock price. What you're going to typically see with earnings per share is you're going to see something called trailing 12 months. What does that mean? Well, if we look at a company like Home Depot, if I was to look at their financial statements, let's see over here, we can do it with Facebook. So if I look at Facebook, so when you look at earnings, when you're looking at earnings per share, the reason why you will typically see this is going to basically be trailing 12 months is really because, well, I can't just use the year-end information. Most of the services that we look at in terms of that do the price to earnings ratio calculations, they will be going through and using trailing 12 months. So what does that mean? If I tried to go through and say, like right now, like GM has a price to earnings ratio of 5.72. If I were to go over here, or 5.71, there's markets changing by the moment. So 5 points, did I say 5.71? 5 point, okay, so it's changing by the moment. Okay, so as I'm looking at this over here, this is generally going to be generally will be trailing 12 months, meaning that I'm looking at net income from the last time it was going through and being reported. So again, the last 12 months, not the December 31st financials, but the concept of trailing 12 months. You don't need to know that, but it's just something to kind of keep in mind. So when I look at different companies, this tells me different things about its valuation. So when I look at General Motors, it has a price to earnings ratio of 5.72. What does that mean? It means it's going to take a little bit more than 5 years or just under 6 years to earn back its stock price. Is that for real? Well, it's a way of valuing how overvalued or undervalued is a company. Tesla is 378.78. And I don't make these numbers up, people. I just report them. Oh, it's even gone up. Wow, this by the moment it's happening. So the price earnings ratio for Tesla happens here. So what does that mean to us? It means that it's going to take 380 years to earn back its stock price. So again, when you look at these numbers, is that out of line? Well, clearly Tesla is very, very investor driven. Investors are very excited about what Tesla, and I think what's even better is like somebody told me about sexy, or when you look at the, and I'm not being, trying to be harassing over here on the videos, but it's the Model S, the Model 3, the Model X, and the Model Y, and that spells out sexy. So good job, Elon, of putting those subliminal messages in there. So we have this over here. Trust me, like I didn't make that up. It's true. So, or at least it says it on the internet. It's got to be true. Okay, so my price to earnings ratio, this is going to take me 380 years. So if I look at all these different ones, like Ford, 15 years, Facebook, 27 years. Now, when I come over here to Snapchat or to Snap, what you're going to notice here is price to earnings ratio is blank. What does that mean to us? Well, the price to earnings ratio, in order to actually go through and to do the ratio, you actually have to have earnings. When we look at a company like Snap, crackle and pop, as we can kind of see this over here, is that even as of right now, Snap has a financial accounting net loss of $151 million. However, but again, just remember this, is that as we look at these numbers can also be very, very deceiving in terms of how these are being computed, right? So just kind of keep that in the back of your mind as you're going through and doing this. But as we look at, we'll have a 0 price to earnings ratio if the company is at a net loss, okay? Now, one other thing I'm just going to mention here is that Snap, for the 6 months ended June 30th, had a net loss of $438 million. Now, is this real? Well, it's real from an accounting perspective, but from a perspective of going through and looking at it from a cash perspective, is that really true? Well, the one thing that I always find fascinating is that if Snap did not have to expense its stock options, whoa, they're profitable, okay? And that's really where a lot of financial accounting can be misleading. Most investors know that stock-based compensation, when this stuff happens, it's really not real. It's real in the sense that we have to record it for financial statement purposes, but stock-based compensation does not cost the company anything. They're issuing shares. So when you're looking at this, just kind of keep in the back of your mind that even though it has no price to earnings ratio, is Snap valuable as a company? And the answer is, I mean, they've gone up. I mean, look at their what's happened with their net income or with their revenues. Their revenues have gone up from 916 million to 1.7 billion. So Snap has figured something out. So we're just looking for crackle and pop. Okay, again, enough of the joke. So that's my price to earnings ratio. Very important for investors in terms of determining whether something is overvalued or undervalued. Now, for companies like Tesla, is that what I have my students do now is that I kind of use something called the price to book value ratio, which is taking the market capitalization. And I want to thank Investopedia for this. Investopedia is great in terms of ratios and everything else. Just Google it. So I've got my price to book value ratio, which is going to be the market capitalization divided by the net assets, okay? Market capitalization, that is generally going to be, and you can also use the market price per share, but what that's going to be is I would take for Snap, I would take 116 billion and I would divide it by the net assets. Now, for the net assets, again, depending on how you're looking at the ratio, it's going to be my assets minus my liabilities minus any intangible assets. So that's going to be like goodwill. It's going to be patents, trademarks, whatever might be on my balance sheet. So as I'm looking at net assets, and of course that means assets when I'm looking at PP&E, I don't look at that as gross. I look at it like equipment minus accumulated depreciation. That would be listed as an asset. So the actual formula is you're taking the stock price, but if you just take the market capitalization divided by the net assets, you're pretty much going to get the same value. So this is something that I would actually say has a little bit more relevance, because even if you're at a net loss, you can actually kind of get a sense in terms of how over or undervalued your particular company is. Okay. So going back over here, so that's price earnings. So that's why earnings per share is so important. So how do we go through and compute these items? So when we're looking at basic, we already just looked at that. But when we have fully diluted earnings per share, and Regina is my inspiration for this video because she said DEPS. And I go, what's DEPS? And she's all, diluted earnings per share, idiot. And I go, oh, she didn't say idiot. I'm added that on. I was like, oh, okay, so I need to do a video about this. So you have over here, so what exactly is fully diluted earnings per share? Well, from Investopedia, because everything on the internet, as we know, is true, I've got net income minus preferred dividends. I'm dividing this by the weighted average common shares outstanding, but I'm also going to be adding into the denominator, fraction talk, are my dilutive shares. And I'm going to do, using the Wiley 17th edition, because I've been given permission to do that, I'm going to go through a lot of different examples about this. But what exactly are dilutive securities? It's essentially anything that is going to be shares or other common stock that could potentially be, or items that could be converted into equity. So what we're going to look at is that if you have convertible bonds, if you have warrants, employee stock options, restricted stock units, I got to look a little bit more into this, but that's really what dilutive shares are. So when you look at a company like Snap, isn't going to be a good one. Let's take a look here. We look at Facebook. So what you'll notice here is basically you say here, like, earnings per share attributable to Class A and Class B common shareholders, 7 and then 6.9. The diluted is slightly less. Why is that? Because more than likely what's being included are going to be employee stock options. And so if I went through Facebook's, so here you have a share-based compensation plan. And so right over here, and the reason why this would be dilutive as well, this is the price of Facebook shares have gone up significantly. And so when you're going and looking at this, if the company were to issue those shares, it would be increasing the weighted average shares, common shares outstanding. So that's basically how we go through and compute diluted earnings per share. Again, this is just conceptual, theoretical. Okay, so again, what's fully diluted is I'm taking the basic equation and I'm adding in dilutive security. So we're going to look to explore what is going to be a dilutive security. Now, the one thing is, though, is that if you look over here, going back to Snap, Crackle, and Pop, right, is that basic and diluted are exactly the same. Why is that? It's because if I'm in a loss position, and if I were to add more shares to the denominator, what would end up happening is my diluted share amount would go down. So when we're dealing with a net loss situation, everything is considered to be anti-dilutive. So therefore, when you have a net loss situation, your basic and your fully diluted earnings per share will be exactly the same. That's why it's sometimes going to be at a loss. Okay, but a loss for a loss. So that's a basic part. Now, the last thing I'm going to kind of talk to you about here today, kids, children, just kidding, all working adults trying to pass this exam. Okay, so when you become a CFO or a senior financial officer and you're trying to go through and raise money, one of the things is I asked an investor, right? Because going back up to here is what's the whole objective of financial reporting? It's to get information to the investor. And when I've spoken with investors before, they'll say to me, Bennett, they'll say, I'd say, like, what can we do better? Right? What can I do better for you? How could financial reporting help you more? They'd say, well, you need to get the PCAOB, or actually really the Securities and Exchange Commission, to create a capitalization table and put that in the front of the financial statements. What is a capitalization table? And remember, why is this kind of important? It's because when an investor sees if a company is in a loss position like Snap, you don't really know if there are other dilutive securities out there, right? So we know over here with Facebook that there are definitely diluted securities. And why do we know that? It's because their basic and diluted numbers are different, right? Very important. We know that those are going to be different because as we look at this over here, okay, so when we look at this over here, when we look at net income, basic and diluted, right? These numbers are different. So if a company is in a loss position, then as an investor, we should kind of have something screaming out at us to the investor saying, hey, we have a lot of other dilutive securities. Okay, so how do we go through and achieve this? The way that so if you're doing an investor presentation and you do not have a capitalization table, you probably should be putting one in there. And even if you're not going to use it, I would just have it in there. Why is that so important? Because a capitalization table, you're going to not only list out the shares that are outstanding, you're also going to be listing out all of the different stock options, warrants, and convertible bonds. And when you're listing them out, it's important to say what is in the money versus out of the money. What does that mean? So, for example, if I had Snap stock options at $100 per share, those options are out of the money. Okay, they're out of the money. Why? Because if I were to exercise them, I'm losing money. I can buy the shares on the open market for $74.03. My option is for $100. So it's kind of like, why are we doing this, right? So the other side of this, right, are in the money options. And this is very important to an investor. So if the options are in the money, right? So the options are in the money. It basically means that if I have an option to buy Snap shares at $7 each, and this is always kind of fun if we kind of look at this here. And oh yeah, and if I do 5 years, and when I was teaching intermediate, or actually it was like around, yeah, it was around like $12, $10 a share, and it's just only gone up. So if I look at, if I'm going through and looking at this, like over time, right, then essentially what's going to end up happening is, again, when I'm looking at this, so in the money options, I have the option to buy it for 10 to 15 bucks. And then basically those are in the money because I could buy it at 15 and then sell it for basically for 73. So in the money versus out of the money. So what my advocacy for is here is that a company, along with its financial statements, you list out a capitalization table. So you would show everything that's potentially could be converted. Now, the reason why this becomes, in my mind, somewhat important to do, and let me go back and find, so this is Home Depot. And I did a video on this like a little bit earlier about AMC, and I'm going to go back to this. So if I go to AMC, and so AMC, famous Wall Street, Reddit, or whatever else you want to call it. So if I come over here, and AMC has been losing money for a very, very long time. And I'm just going to pause really quick to pull up the 10. So if I come over here to the March 12th, 2021 annual report, and this is for the year ended December 31st. This is basically year ended December 31st, 2021 or 2020. So if I come down over here to the financial statements and the supplementary data, What you're going to notice here is this company is at a pretty big loss, especially during the pandemic. They lost about $4.5 billion. And what you're going to notice is over here, they have various different corporate borrowings, okay? Now, in terms of these corporate borrowings, some of these are, okay, so these offset of a conversion of $600 million of convertible senior notes. So investors converted their shares, and that's what happened, right? So they went through and basically they were going through and they were issuing out basically convertible notes. What's convertible? Basically, a convertible is essentially I can go through and convert it into common stock. Why is this so important for an investor? Well, if I say own 10% of a company, do I want to know if there are other shares that are dilutive, meaning that all of a sudden I own 10% today and tomorrow I only own 5%? So dilution is a huge issue for investors. So when you're a CFO and you're out there on the road and talking to your investors, you want to make sure you have the information about, okay, what are the potential items that could dilute me as an investor? That is extremely important to do as you're going through this. And this is really why diluted earnings per share, believe it or not, is actually important to an investor. It's just because what if everything converted? Then how much do I actually own of the company? So that ends this first part of the overview. I know it's a very long overview, but it's my first part. Again, I want to give a big shout out to Regina. I wish her the best of luck in studying for that CPA exam. And I want to thank you. And if there are any other topics that you want me to go through and cover, please feel free to go through and leave a comment. Thank you so much and look forward to seeing you on the next video. Have a good one.